All right, my friends. So, part two of what Karen needs to do to minimize taxes in retirement. We're going to do Roth IRA conversions now, just starting right out of the gate. We're going to start this year, 2019. We're going to do $20,000 a year until the IRA is fully exhausted and now solely over in the Roth. So let's take a look at what that looks like. Don't forget to subscribe down below, thumbs up, share the video, the whole thing. So here I'm showing you we got $20,000 annual IRA distributions, Roth conversions, because this tiny little inconspicuous check mark that says convert to Roth. That's what we're going to do. And we're going to convert it. The default's 2034. I don't know why that is, but by this time, there'll be nothing left in the traditional IRA. So we're going to convert 20,000 a year. We can change this whatever we want, but I just want to show you what it looks like here. Standard rule, penalty free, tax free. No, none of those are. There is penalty free. It's just not tax free. But anyway, so let's see what this looks like here. So now we're going to do the Roth conversions. Let's take a look at the tax on having done that. Yeah, and you can see here we got a little bit more on the front end because remember back then 68, 69, and basically 70, she had no tax or they had no taxes whatsoever. Now it's just 5% to the feds, 5%, 6%, jumps up a little bit here to 7.1. Then basically there's nothing there. And then that's I'm not sure why we got such a big tax hit right there, 83. Do I not have old, let's take a look at, we have Ken. When did we have him dying? Thought we changed it to 90. Oh, 82. No, I want that 90. There we go. Okay, cool. Good. All right. So now that was it. That's a widow's tax trap there. So let's take a look at what we're looking at from a tax perspective here. Now yeah, there we go. Oh yeah, look at that, man. It's not quite. It looks different just because it's not as it's not high, nearly as high as a tax rate was before. But here you got less than we have 5.8, 7.1, 6.8, drops to basically 1.2. Then it starts going up a little bit, and then you got the state tax kicking in a little bit. So that's pretty significant. So let's go over here. I want to go to, in this first year they're doing it, they got a pension of $13,300. They got $20,000 of IRA Roth conversions. They have Social Security at $50,000. So you take the $33,300 for the Roth and the pension. Provisional income would make $18,000 taxable. Social Security, about a third of their Social Security is taxable, which gives them total income of $51,582. That's their AGI. You take out your standard deduction. They got $24,000 of taxable income, all right, which basically, for the most part, puts them in the 10% bracket, but a little bit will be in the 12, and that makes them pay tax at $2,562 in total taxes on $83,000 of income. That's, my friends, that's pretty doggone good. I'll tell you that right now. It's pretty doggone good. Look at that. $83,000 of income, $2,500 of taxes. So if you can see what I'm talking about here, we go to, I want to go back here. Bear with me just a second. And what you'll see, the estimated effective tax rate, federal tax rate is about 5%. So you're basically the effective tax rate is 5%. I actually think that's even wrong because if you're only paying, well, let's take a look here. If you're only paying tax of $2,500 or so on roughly $83,000 of income, let's see here, $2,500 of taxes, and their income is what? They only got 63,000. You know, what was I talking about? Oh, because see, but they're not counting the pension, the Roth as income. Okay, gotcha, never mind. So basically, what they're doing is they're taking the $2,500 of taxes they're paying, dividing it into their two sources of spending money. That makes sense. And it's an effective tax rate, but that's somewhat confusing because a Roth is not going into that income. So but it's still income. So their total income is $83,000. They're only showing $63,000, which is why they have an effective tax rate of 5%. I'd actually say there's an effective tax rate of 2.5%, simply because they have $2,500 of tax or up 3 on $83,000 of total income, but taxable income. But I see what they're saying too. They're saying, look, you're not spending the Roth. Okay, split hairs. Anyway, either way, it's low. Let's just put it that way. All right, so let's keep going here. Let's look at the taxes, and what we'll find is you see 2,300, 2,600. We go down here. I mean, it's low. I mean, it's just look at that. California's 2,000. I mean, never paying more than $7,000. Let's go to the accounts. Go to ending balance. So now they're taking these mandatory, so they have net flows into these taxable accounts because they're not spending enough. And that may or may not be the case in real world. I don't know. Let's look at addition to accounts. Yeah, so they have all these surplus cash flows going in, which is adding to the taxable accounts, which is increasing their tax a little bit. That's probably not going to happen the way it's shown here, but I don't know. I mean, at the end of the day, still going to show you how the Roth can reduce her taxes. We're probably showing a lot more of taxes than actually what's going to be paid, simply because they have him with $696,000 of a taxable account. We have a 2% dividend rate and a 5% turnover. And if we go, that's 2038. Let me show you what the 1040 looks like in 2038. Time check. There's my wife. In 2038, let's look at the 1040 to show you what it looks like. And still not that much. You get taxable interest, 5,300, 8,300 qualified dividends of that's just not that much, but it is adding something. So it's adding another 13,000 of taxable income at 15%. The bulk of that, well, actually, no, it won't even be 15% because they're taxable. No, so even that's tax free because their taxable income is still in the 12% category, or in this case, it'd be 15% because the Trump tax bill has sunsetted. So that's not even taxable. So that's irrelevant at this stage. Okay, cool. So that's good. So now I want to go back to, and what I want to do is I'm going to grab this cash flows here. And this is with the Roth conversions. And we're going to compare this to the other cash flows without the Roth conversions. All right. So let's see what we got. We'll go to our spreadsheet. And then we're going to kill off old Ken earlier like we did last time and see what we got here. So if we could, all right. So now we got our tax payments. Oh, yeah. Look how small that is. That's going to be, all right. Hold on just a second. All right. So we got our tax payment there. And we're going to go here. And $79,000. Look at that. $79,000 in total income inflows. I mean, and we have total income inflows 1.9 million. I mean, it's right there. Look at that. $2 million of total income inflows, $79,000 of taxes. We had $2 million of total income inflows before when we killed off Canada early, and we had $193,000 of taxes. I mean, we had $2.2 million of total income flows when we didn't kill off Ken early, and we had $147,000 of taxes. So let's just kill Ken off early here, and just to get a gauge if of the taxes when Ken's dead earlier, and Karen is no longer married filing jointly, but she's a single taxpayer. We're just going to come off at 80. I can't remember what we did last time, but we're going to say 80 just for simplicity. And let's go to retirement. And then we're going to go to cash flows. And then we'll copy and paste this right here. And we're going to get a gauge. Yeah, see, oh, look at that. There it goes again, man. Her taxes go up just because she has a standard. She's just a single taxpayer. It's not going to be nearly as bad as what it did without the Roth IRA. But, I mean, man, you've got to. And we're going to go to tax payment right there. So let's sum that guy up. All right. And we're going to see what we got. Right there, blink. 122. So when Ken dies off early, you're still paying more taxes. Total income flows 1.7 million. So at the end of the day, we're paying, in this case, we're paying equals that divided by that. 7% total taxes. All right. Equals that divided by that. 3.9% equals that divided by that. 9.8%. And then here, that divided by that. 6.5%. So you can see we are tripling the taxes roughly by not doing Roth conversions. I mean, in terms of the percentage of tax that we're paying. So the Roth conversions, and Ken survives as long as Karen does. We pay $79,000 of taxes on almost $2 million of income. If Ken dies earlier, we're paying $122,000 of taxes. We're paying $50,000 more in taxes on $200,000 less of income. That's with the Roth conversions. Without the Roth conversions, we're paying $193,000 of taxes on $1.96 million of income. That's if Ken dies early. Without Ken dying early, we pay $150,000 of taxes on $2.245 million in income. The Roth conversion, there's just simply no other way around this. Absolutely start doing it now. All right. That's all I got to say. That's the proof is right there, my friends. So as always, if you like what you see and if you find value in this, give me a thumbs up. That helps me. Share the video with others for sure. Comment if you want to donate, because you do find $5 or $10 or $1 million of value. Go to heritagewealthplanning.com. On the very bottom, you'll see a little thing that says donate. And by all means, send a donation. Be much obliged. But either way, don't forget to subscribe, and we'll see you next time at heritagewealthplanning.com. Thanks, guys.